Incremental free cash flow. In the previous module, we included incremental revenue, costs, depreciation, and tax to calculate incremental earnings or profit. In this module, we'll see how we convert from earnings to cash flow. There are a number of steps involved in converting earnings to cash flow. The first step is to deal with the fact that we've included depreciation as an expense in order to calculate EBIT, tax, and therefore total earnings. But depreciation is not a cash flow, and therefore we need to take out the effect of depreciation. The second step is to include cash flows that occur at the beginning of the project that are not considered part of earnings. Initial equipment, other development costs that have been capitalized for depreciation purposes, and increase in net working capital. There are a number of cash flows that occur at the end of a project, which we call terminal cash flows, and we will deal with one of these in this module, which is the recovery of net working capital. In the next few modules, we will deal with these remaining terminal cash flows. Here is another look at the step-by-step process. We start with earnings. We add back depreciation because we've deducted it in calculating earnings, but it's not a cash flow. We subtract capital expenditure at the beginning of the project because this is a cash flow that has not been included in the calculation of earnings. We also deal with net working capital. There's normally an increase in net working capital at the beginning of a project, recovery at the end of the project. Both of these are cash flows that are not included in the calculation of earnings. After making these adjustments, we arrive at incremental free cash flow, which is what we need to calculate the NPV of a project. As was just mentioned, there are additional terminal cash flows which also need to be included as incremental free cash flows, and then we'll be in a position to calculate the NPV of the project. This is where we got to in the previous module. Revenue minus costs minus depreciation gives us incremental EBIT. We deduct tax, giving us incremental earnings. In this module, we'll start from incremental earnings and then make the necessary adjustments to move from earnings to cash flow. The extra information we need in order to complete this process is that the increase in net working capital in year 0 is equal to 15% of incremental revenue. Working capital refers to short-term assets and liabilities, generally accounts receivable, inventory, and accounts payable. Net working capital is the difference between short-term assets and short-term liabilities. This will generally be a positive amount, which ties up cash for the life of the project. This means that by injecting cash into working capital, we have a cash outflow at the beginning of the project and a cash inflow at the end of the project when that working capital is recovered. So starting with incremental earnings of $91 per year for 4 years, we add back depreciation because we subtracted it earlier when we were calculating earnings, but we have to add it back because it's not a cash flow. The capital expenditure was $1,000 in year 0, so that's a cash outflow at that point in time. In this project, incremental revenue is $500 per year, and therefore we need net working capital over the life of the project equal to 15% of $500 or $75. We have a cash outflow of $75 at the beginning of the project and a cash inflow of $75 after the project is completed. Even though these amounts are equal and opposite, we need to include them because they occur at different points in time and therefore they have different value based on the time value of money. So the incremental free cash flow for each year of the project is negative $1,075 in year 0, $341 each year from years 1 to 4, and $75 in year 5 after the project is completed.